you play the cards you've been dealt, and if this means that silver has been driven down and you can buy it cheaper, back up the truck and buy it.
Ladies and gentlemen, welcome to the special interview. Today we have a returning guest to the show, Simon Popple. Simon runs the Brookville Capital Newsletter. I suggest everybody heads over to brookvillecapital.com and checks out the newsletter. And Simon's newsletter is not just about picking the miners, but coming up with a strategy. And that's going to be very important to navigate your way through this sector in the next bull run. Simon, I'd like to thank you for returning again to Silver Doctors.
Great to be on the show.
Now, Simon, you focus a lot on the gold and silver miners, but silver in general has been catching your attention a lot lately. Could you tell me some of the things that you've been seeing and thinking about with the silver market lately?
Absolutely. Well, I think the first thing is, the ratio, which is something everyone's sort of really been looking at and talking about, because at the moment it's sort of around 80 to 1. Historically, it's been more like sort of 58 to 1. So, that implies that, the silver price has got a bit of room to head north. I think, at the moment it's it's around the sort of $18 an ounce. If you go back to the ratio, the sort of 58 to 1, that would imply it should be around $26. So, I think silver is a very interesting metal because not only does it have the kind of safe haven aspect to it, but it's also very much an industrial metal, with electric cars and solar. So that kind of got me looking at it. And then I sort of started to switch more into the physical silver, if I'm honest, and kind of scratch my head as to why more people don't actually hold physical silver, whereas, people seem to be increasingly moving towards physical gold. And initially, I thought it would be because of storage costs, because silver is a lot bulkier than gold for the same value. But that's not really the case, because your storage costs, certainly here in the UK, are more to do with the insurable value of the silver rather than how much space it takes up. But what is actually causing people to perhaps steer away from buying physical silver, particularly the coins, is the the high premium that you have to pay over the spot price, which can be sort of 40-50%, and here in the UK you have to pay VAT as well, which is 20%. So people, if you're not careful, you're paying 60-70% above the spot price for your silver, which clearly turns a lot of people off.
Let me stop you right there, because that is amazing what you're telling me, Simon. Here in stateside, we have a lot of low premiums on silver right now, especially on 90%, what we like to call constitutional silver. On generic rounds, premiums have been under $1. Now, the one thing I am seeing here is, and the point that I'm getting at is because there's like this window of opportunity right now, and this is also especially towards the American buyer. I want to get your perspective on this, because this VAT tax thing, that's big. 20% is big. And here what I'm seeing is the various states are starting to charge sales tax on gold and silver now. And they exclude some products depending on what it is. Some of them don't. But that could be like 7% in some states. It could be over 8% in some states. So I guess my point is, as we've been consolidating here, call it 17.75 to 18.25 in the dollar price. This is an interesting window, especially for the American buyer, because we can see that governments around the world have already been implementing these kind of tax structures on the physical silver, but it hasn't really yet taken shape here in the United States. And it's presenting an interesting case for physical silver possession in hand. Does that logic make a little bit of sense there? And why is the VAT tax, what makes you think about why the VAT tax would be so high in Europe or in the UK or things like this?
Well, the VAT is kind of here to stay, and you can get VAT free silver, but you can never take physical delivery of it. And I think some people they want to take physical delivery because they see it as a safe haven asset. And I think that if you look at a I know the value of a silver coin, it's probably in dollar terms $20 to $30, and people are kind of probably quite happy about walking around with a bunch of silver coins worth $20 or $30 each. And should they have to ever spend it, that's a sort of reasonable amount of money to have for whatever you want to get. The problem with gold is gold coin is typically more like $1,000. So great if you're going to buy something expensive, but if you're just going to get some groceries, you don't really want to have essentially $1,000 note in your pocket. So I think everyone's got different reasons behind having physical gold or physical silver, but the tax angle, the fact that certainly in the UK that silver attracts VAT whereas gold doesn't, is certainly leading people more away from silver and towards gold.
And that's very interesting because one of the things that I've been talking about for the last couple months just has been the gold to silver ratio, as you were talking about. When President Trump was inaugurated, I think the ratio was like 64. So even that would imply, higher than $20 gold price right now, or silver price right now. So here's my point about that. The reason why I've been talking about silver so much is because with the ratio of 80, right? Let's say it reverts to the mean. You had brought out 58, but let's say it overshoots that and goes down to 40, right? Basically what that means is that right now you can get 80 ounces of silver for 1 ounce of gold. But when a ratio reverts and overshoots, let's say it goes to 40, well, then all of a sudden it doesn't take 80 ounces of silver to get 1 ounce of gold. You can get 2 ounces of gold with 80 ounces of silver. So even with that dimension there and the gold to silver ratio arbitrage, it almost sounds like, yes, there's that VAT tax on the one hand, but also there's that opportunity at the end of the cycle to turn those ounces of silver into free gold. Does that sound like an interesting play on silver there?
Yeah, no, absolutely. I mean, if you look at where the silver price is now, let's say it's $18 an ounce, it has been as high as 55. And so, if it gets anywhere near there, you don't really care about the premium, to be honest, and the tax. So I think that when people actually see the silver price moving up and sort of, it's a very volatile metal, but I mean, I think if they can kind of get comfort that it's always going to be, over 18 or 19 or whatever it is, then, I wouldn't surprise me at all if you have more people moving into the silver market and, this increase in demand for physical silver, especially on top of what you've got from, industrial applications such as solar and electric cars, could really start to move the needle and reduce this ratio as you just alluded to.
Mm-hmm. Yes, that's very interesting. And when we're talking about the interest coming back in, some of the things that I'm just seeing are just saying that there's this perfect storm out there that people like to throw out that analogy. For example, last week, the CEO from SD Bullion was talking about, authorized purchasers from the Royal Canadian Mint are going to be limited on how many Canadian maple leafs, 1 ounce, like literally the bread and butter of the Canadian Mint, how many they can purchase. So there's already starting to be signs of rationing. Another thing that I see that's coming, this is just kind of also anecdotal, and I'd like to get into this a little bit later with you, is, during our live streams a couple months ago, we started this phone call feature where people can call into our show and ask us questions. One of the things that I'm seeing is we're starting to get a lot more questions related to gold and silver mining and stocks in that sense. And then just yesterday, with what the Federal Reserve did, they cut interest rates again. And then on top of that, they've been doing emergency liquidity injections into the repo market. So my point is there's all of these dynamics right now that say to me, silver is set to go on its next run here. Are you seeing other fundamental factors like this that are showing you that silver could be ready to go on another run here, Simon?
Yeah, I think there's a lot more interest in the sector. And I think that, if you look at what happened in previous downturns, people kind of moved from equities into bonds. That, that's a very tried and tested route that, people would move from, what are considered riskier assets into less riskier assets. And I think that with in equities being where they are and bond prices also being pretty high and negative yields and things like that, that people are looking at other areas. And, gold and silver naturally are areas that, people are looking at. And I think with all the money printing that's been going on, people are starting to get sensitive, to that. And the fact that you can't print gold and silver and it is scarce is making it far more attractive for people to, to include in their portfolio.
Mm-hmm. And, when people include gold and silver in their portfolio, there comes a time where they're starting to realize, well, why did I put it in my portfolio? And then they take it one step further and they say, well, how can I diversify a little bit? And they start talking about the gold and silver mining sector. And that's where we get the questions. So just, in general terms, because, and we've seen this with the recent phenomenon with the blockchain stuff, where companies were changing their name to blockchain and then the stocks were just going parabolic and then they just crash. So here's my point. I can see people going in there and just picking stocks, gold and silver mining companies or ETFs or something just based off of the name. And that's not a good thing. A person needs to have a strategy. But just to back it up a minute, like, what is the difference between like a gold and silver ETF, a gold and silver mining ETF, and then a gold and silver mining company? And is it important to diversify those? And is there a strategy that's needed to be able to move in and out of those? Because this is not something you also want to just buy and hold over the entirety of the cycle because of the volatility that we're talking about. So I kind of just went all over the board there because there's so many questions. So I'd just like you to take that question in any direction you'd like to, Simon.
No, great. I mean, I think the thing is, ETFs, everything's got their place, but with an ETF, you've got counterparty risk. Because there's someone running the ETF, and some ETFs have physical silver or gold, and others have derivatives that are essentially a proxy for the gold and silver market. What I like about the miners is they're actually digging up physical gold or silver or whatever it is out of the ground. So doing sort of analyzing them against your kind of blockchain projects. What you've got with blockchain is really kind of conceptual, whereas what you've got with the miners is a physical, tangible asset. They have got their JORC or whatever sort of analysis they've done, and they can say there are reserves of X, there's resources of Y, and they've got a proven asset, which is physical, and that's what I like about them, because I think they're in a way, in a very crude way, they're actually kind of mining money, because they're mining something that will have a value, and it's got not just a value in that country, but gold and silver are also universal.
Now, with these recent runs since the end of May, and then again in June in gold and silver, the miners at these prices should be able to be tread water. How are the miners holding up with this now move in price that we've seen? Are they holding up?
Yeah, it's very interesting, because I think this is where the newsletter adds a lot of value to people, because all the miners are different. You've got producers, and some of them are large producers. They've got multi-billion-dollar market values, and they have got they've been in the market for years producing gold, silver, whatever it is. And these kind of companies are very sensitive to gold and silver prices, because they're so large that they'd have to make an absolutely huge discovery for that discovery to have any impact on the overall value of the company, because the company is just so large. So those kind of companies I think are very interesting. And then I kind of do a fantasy football analogy, and I'd have them as my goalkeepers and defenders. And then in the midfield, which is sort of more risky, are your new producers, who perhaps don't have the track record of production, and they know less about their asset, where a discovery can have a meaningful impact on the share price. And then you've got what I would call your forwards, which perhaps are your wide receivers or quarterbacks in American terminology, which are kind of explorers, and they're the kind of companies that you kind of really need to know what you're doing, because you could, on the one hand, you can make a lot of money, but on the other hand, you can lose a lot of money. And going back to your point about gold and silver prices, they tend to affect initially the producers, and then as explorers find more gold and the gold price moves up, what you have is, as the gold price or silver price moves up, it means that more of their resources can be defined and are economic, because at a higher gold price, it means that a greater percentage of their resources are generally economic to mine. So their resources go up, and if the resources go up, then invariably the value of the company goes up.
Because they can bring more gold to market is one of the points there, where if the resources go up and gold becomes more lucrative to mine, not only are they getting more money for their gold, but they're also bringing more gold to the market. Am I understanding that right?
Yeah, I mean, obviously, there's if it's just a pure explorer, there's a cost of exploration. But if the gold price is higher, then they're more likely to attract the money to put the mine and the processing plant in place, because they're economic to mine. And with a depressed gold price or depressed silver price, then it's difficult to raise the money unless you've got an economic asset. And obviously, that's one of the sort of the rookie mistakes that a lot of people make when they're looking at the mining sector, is they look at the resource, and they may get very excited about seeing a resource which is 1 million ounces. And if that's in 1 or 2 deposits, that could be fantastic. But if that's across 8 or 9 deposits, then what that means is you could well have 8 or 9 uneconomic deposits, which means you'll never get your money back.
Mm-hmm. Now, and speaking across different deposits, when we're talking about these multiple geographical areas, do you see, because this is one of the reasons why I'm saying that, it's not something that you would just buy and hold for the long term, but you actually have to be nimble and be able to move in and move out of positions when the time is appropriate. And one of the reasons why I'm saying that is because, is there geopolitical risk with these miners? Like, for example, Steve Santangelo just released an article about like the largest or the second largest silver mine in Mexico is shut down because of like protests and problems with truckers. So I guess my point is, you can't just invest in the miners and just be done with it, but you actually have to kind of follow what's going on so that you're not exposed to this kind of risk. Could you talk to a little bit about that, Simon?
Yeah, no, absolutely. I mean, again, that's one of the benefits of the newsletter, because sometimes you make a call on a stock because you think it's undervalued, and people should be looking at it. But then they could have a project in Peru or Argentina, which have recently had some mining challenges, and people need to be aware of where these assets are. And unless you're looking at the market every day, you could easily be in a stock and think, oh, that's great, and suddenly for something that's happened left field, nothing that is really pertinent to that company, the stock goes down because a mine's been appropriated in Argentina or Peru, or there's been some major challenges that mean that people are concerned about mines in certain jurisdictions.
Now, I've been going heavily into physical silver for the past, I think 2017. In about the middle of 2017, I really switched over to all my purchases in silver just because of the ratio. But do you have any kind of like of your like let's call it precious metals in general? Do you have, like, for example, my personal ratio is somewhere around 75 ounces of silver to 15 ounces, or 75% silver, 25% gold. Now, would you say if you want to diversify into the miners, like you obviously don't want to put all of your precious metals money into the miners. So if you're talking about, you have money to invest in precious metals, would you say like 10% is a good percentage that you could invest in miners? Because there is risk here, right? Like if you hold a gold or silver coin in your hand, there's not the risk that it's going to go to zero because it's stored energy, as people like to call it. So what would you consider a diversified portfolio as far as having a balance between gold, silver, miners, ETFs? Could you speak to that a little bit, Simon?
Yeah, no, absolutely. Well, I mean, I think that it's quite difficult to put it in percentages because it depends on your risk.
Hold on. Hold that thought 1 second, because I want to state it just how we got it on the phone, right? Because the phone call comes in, and here's the question, and it's so basic, but I have some. So I'm going to say it as the phone call comes in because I kind of ran around the bush on it. The phone call comes in, and they say, "I have some gold and silver. Should I buy some gold or silver mining companies?" That's the question we've got a couple times over the last couple weeks that keeps recurring. So when I ask you the question, and then that question in consideration, speak to that, Simon.
No, sure. Okay. Well, I mean, I think the answer is probably yes, but you need to think about how much risk you want to take because all these companies are different. And so, if you want to take a lower risk, then I'd sort of point somewhere in the direction of a very large producer or even royalty company, where if the gold or silver price moves up, you'll benefit, or the shares certainly should benefit. But some people may want to have a bit of we call it magic dust, where they rather than the shares just improve and go up, they've got potential to make a lot of money. And I think if you're that kind of person, then obviously you want to have some, speak to your financial advisor, but have something in the lower risk category. But some people may want to have something slightly higher up the risk curve. And if that's what you want, then I think that's where newsletters can really help you, because they can introduce you to stocks that you just won't hear of or are very unlikely to hear of in the ordinary course of business. And what I'm particularly sensitive to is that I provide completely independent analysis. I'm not paid by any of these companies to promote them. So if people come to me and say, look, I want a sort of medium risk stock, what should I be looking at? I can give them a few that they should look at, and I can help them analyze it. And it's the same if they want higher risk, because I speak to the community every day. And so, I kind of know what's out there, and it depends on their appetite for risk. I know it's a bit of a long-winded answer to your question, but if they like a lot of risk, then they should probably have a bit of everything. But if they're very much sort of lower risk mentality, then they probably want to look at the larger companies in the space.
Mm-hmm. And in addition to looking at the companies, the system is what's critical, having a strategy to do that. Now, I don't, want you to give away your, exactly what you do to your paid newsletter subscribers, but just in general, could you talk about like what your approach is to looking at companies? Because I know that you have something called the bridge system. Could you explain what your strategy is?
Yeah, no, absolutely. Well, I mean, I think it really falls into two camps. First of all, I'll deal with the bridge system, which is a way I use to analyze the stocks. Basically stands for balance sheet, resources, infrastructure, diversity, grade, and exploration potential. So I look at all these facets. But I mean, as you alluded to earlier on in this chat, it's all about the timing. And I think the strategy is incredibly important, because it's a bit like people who've made money out of real estate. It's been a fabulous time to invest in real estate, but it's everything has their day, and there'll come a point when it's not such a good time to invest in real estate. And I think that what can happen with I'll do an analogy of real estate. Someone buys a house, they put a lick of paint on it, and they put a new bathroom and kitchen in, and they sell it at 25% profit, and they think they're a property developer. Chances are you'll find the market has moved. Yes, obviously what you've done has helped, but it hasn't created all the value. And someone once said to me, never love anything that can't love you back. And I think these silver and gold stocks are very much in that camp, where they can potentially make you a huge amount of money But one of the problems that people have is, and I certainly had it myself, is you you buy a stock, you make a lot of money, and then you sell it, and you just see it continue to go up, and then you can buy back in and still make money, and then suddenly the market crashes, and you're left with something that you've lost a lot of money on, and that's where the strategy is so important, because people need to have a game plan as to what they want to achieve, and once they've achieved that, quite frankly, get out of the market and get into something else. So, I'm not a gold bug in terms of, you should buy gold, it's the answer to everything. I just think the timing now is very good for people to look at the market, and, potentially they could do quite well.
And because the counter to that would be, well, they've already moved this year anyway. So, I mean, I've kind of missed out, but people have not missed out on the mining sector bull run. It's barely getting started. Is that right, Simon?
Yeah, I mean, that's my opinion. I mean, I think also if you look at, gold, it's let's say it's 1,500. Previously, what, 8 years ago, was 1,900. And silver is about $18, and again, sort of 8-9 years ago, it was $55. So even if we went back to previous highs, there is huge potential in the market. And people are talking about breaking through those highs and potentially much higher gold and silver prices. So if we did have that, people could be making huge amounts of money.
And Simon, I would be remiss if I did not ask you for an update on what in the world is going on with Brexit, because I know, I'm not looking for you to make a political stance or anything like that, but here's what I'm getting at. The trade war was a huge issue, but with this oil strike on this Saudi oil, with this drone strike on this Saudi oil facility, now there's talk about real war. And then attention shifted to the Fed. And then first attention shifted to the ECB and Mario Draghi and what they're going to be doing. Then attention shifted to the Fed. So, my point is Brexit's kind of calmed down in the news cycle, but we're coming up on October, and my understanding is that October is something that is important. So just if you could give our update on to our listeners, what is going on with Brexit?
Wow, what a question. To be honest, no one seems to know, because we're told that progress has been made, but then we hear that no progress has been made. And in the last day, we've been told by, I think, the EU that we've got to come up with something in 11 days, which I think they're going to struggle to do, to be honest. And we've got obviously Johnson has prorogated Parliament, so that's in the courts as well. The whole thing is a real mess, and I think that it's one of those things which no one really knows what's going to happen. It could be a storm in a teacup and nothing happens, or it could be major problems. And unfortunately, I don't think we'll know until we get there. So sorry to disappoint you, but yeah.
But one of the interesting things about it is, gold hit all-time highs in the British pound first, but then it just recently hit all-time highs in the euro. So it seems like under the surface, there is just still this, as far as the uncertainty, one of the reasons that gold is strong here could be because of this uncertainty, especially as we're seeing it in pound terms or in euro terms. Am I thinking about that correctly there?
Yeah, I mean, it's interesting. I mean, gold is, I think what is great about gold is it's a universal asset. So, if people are worried about the pound, they can always buy gold and, wait for Brexit to pass and then, sell their gold. And, they may lose a bit, they may make a bit, I don't know. But the point is they're buying a universal asset. That's what safe haven assets are all about, really. In times of concern and worry, people can buy them, and, they're looking more to sort of protect their wealth than necessarily make any huge wealth. So I think that, if people want to do that and protect, their pounds or euros or whatever it is, now would be a good time to look at it.
And final thoughts that you could leave our listeners with when it comes to silver, Simon?
Silver, don't rule it out. I think that a lot of people have already moved into some sort of gold, where it's physical or ETF or mining stocks or whatever it is. But don't forget silver. I think you need both.
Simon Popple, I'd like to thank you for joining us today on Silver Doctors.
Thank you very much. Really enjoyed it. A lot of people have rubbish gold and silver because it doesn't yield anything. And I think that because you've got negative yields on bonds, suddenly gold and silver is, you're like, well, you've got something. Okay, there's a storage cost, but view that as a negative yield. But at least you've got something that's tangible that could help you in an inflationary period. And the argument of it doesn't yield you anything has gone out the window because neither do bonds. Mm-hmm. And I think that's quite a big game changer for the market.
And then also, I don't know, I follow the 10-year. I follow the 10-year as far as
I'm the same.
So it's amazing because people. I always talk about the bond market as not a safe haven because I think that ultimately we're going to a fiat currency crisis. But people who would have bought bonds just 2.5 weeks ago bought 10-year notes. They've lost a massive amount of money, right? With all the with all the selling that's been going on. So, interest rates spiking, price going down. If you would have bought the 10-year, September 5th is when that bond market moved. And then yield on the 10-year went up 30% in 2 weeks.
Yeah,
so.
No, it's, I think there's a volatility issue there as well, because if you've got a yield of, 0.1 and that goes up to 0.2, that's 100% difference in your yield. Mm-hmm. And, I think that's from a gold silver perspective, I'd much rather buy something that's going to move, may move a few percent, but
because that's the thing. They're like, oh, well, gold and silver, they're highly speculative, they're highly volatile. When you go to a safe haven, you need something that's stable, but the bond markets are anything but.
Exactly. We don't have inflation, but if we got inflation, that would wipe people out. Mm-hmm. It's bad enough, let's say, having a zero yield, but then if you're not only having a zero yield, but let's say you get inflation of 10% or something like that, and you're essentially losing 10% a year, of a 10-year bond, good luck with that.
I think it really does come down to, people really think that the central banks can keep this going forever, right? Because that's the only reason, is because the central banks are going to scoop up these negative yielding bonds at a higher bond price. That's the only reason. So
yeah, and I think this week was particularly scary because we've got the euro, QE in Europe, we've got the US cutting rates again, and the repo market almost blew up. It's everything's happening quickly, you know what I mean? And it's I think if we had to wait a year before the repo market had a problem, or a year before there was a Fed cut, then I could see this perhaps going out over 5-10 years, but because everything's happening so quickly.
And not only that, a couple weeks before the repo market started blowing up, the Fed started expanding their balance sheet. They started purchasing bonds. I don't know the exact details or the exact amount. It wasn't a whole lot. It wasn't like the 50-some billion that they spent 2 days ago, and then I guess the 80 billion yesterday. But so they've started QE again, and they haven't even announced it. So that just goes to show you how fast these things are going, because they're cutting rates every meeting now. They've started QE even though they're not calling it that. And once they do call it that, my goodness, it's going to be a massive amount of purchases that they're going to be doing.
Oh, so. Exactly. And I think the initial QE, people thought, well, they're printing this money, but then they're going to take it out of circulation in so many years. But now that hasn't happened, and there's even more money printing. Yes. The whole faith of the system is, I say on my website, you can paper over the cracks, but they're still there.
Yeah.
And,
yeah.
And
they're not even filling them in; they're just papering them over, and the cracks are getting bigger.
For Powell not to mention the repo market in his speech yesterday, considering the chaos and the amount of money or liquidity that was pumped into it, there was no mention of it whatsoever, which is again, it's kind of disconcerting. Even if you just said, yeah, the repo market was a bit of a mess and we had to pump some money into it,
Yeah.
I think people go, yeah, okay, yeah, we know that. But
the amazing thing to me is, so they cut interest rates, the repo market's blowing up, they're obviously printing money again, and what happens to silver? It gets hit to like 1750. So it's like,
it's just like, oh man, but I think at the end of the day, that's why the physical market is, we have to view, you play the cards you've been dealt, and if this means that silver has been driven down and you can buy it cheaper, back up the truck and buy it. I think the same is really for the mining stocks. And again, when we get on the call, there's certain mining stocks that have got a lower all-in sustainable cost, and I think companies like that you should buy with both hands, because it could be that the gold price does go down or the silver price does go down. We don't know. No one knows. But if it does, then you want to be in a mining stock that's still making money, even if they're making less money.